Hi, I'm Abby,
I'm Kristen.
and we're going to be talking about how the Fed has different monetary policies depending on the state of the economy. So our first problem is unemployment and recession, which means that there's not enough money circulating in the economy and there's less jobs, which means less income for people to spend in the open market. When this happens, the Fed is going to implement what's called the expansion monetary policy. First, what they're going to do is they're going to buy securities from commercial banks in what's called the open market purchases. That means that they're going to give banks excess reserves for the securities, and the banks are going to have more money to lend out. They're also going to lower reserve rates, which means that there's not going to be as much money in reserve. Last thing that they're going to do is lower the discount rate, which means that they're going to encourage more commercial banks to borrow from the Fed, so more money is being lended out and stimulating the economy. When the Fed does these three things, it's going to increase reserve rates, excess reserves, it's going to increase money supply, the GDP rises, interest rates fall, and investment spending increases.
So when there's a problem with inflation, basically it means that there's too much money in circulation and the economy is growing way too quickly. So basically the government's going to implement a restrictive monetary policy. The Fed's going to do three things to try to fix the problem with inflation. First, they're going to sell securities through open market sales. Second, they're going to increase the reserve ratio, so there's basically less money in circulation. And they're also going to increase the discount rate to discourage banks from lending money out. So when the Fed does these things, there's going to be a number of outcomes that occur. Basically, excess reserves are going to decrease, GDP is going to decrease, interest rates are going to go up to, again, discourage spending and borrowing from banks. Investment spending is going to go down, and the money supply is going to go down.